Many know Warren Buffett, the most famous investors of our time. But what if I told you there's another great investor from whom Warren Buffett learns, and you probably never heard of him, a giant in the world of investing? His name is Howard Marks, co-founder of Oak Tree Capital. Under his leadership, the firm has constantly outperformed the market with returns that are nothing short of amazing. Mr. Warren Buffett once said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something." In this video, I'll break down some of Howard Marks' most profound lessons, insights that every serious investor needs to know. Howard Marks is widely regarded as one of the greatest investors of all time. Over his career, he famously outperformed the US stock market by more than 2,000%. He earned a bachelor's degree from Wharton School of the University of Pennsylvania and an MBA from University of Chicago Booth School of Business. His career began at Citicorp in 1969, where he specialized in equity research on high-yield bonds. In 1985, he joined TCW Group, leading its distressed debit and high-yield bond investments. Then in 1995, Mark co-founded Oak Tree Capital Management, which has grown into a global powerhouse, managing over $170 billion in assets. Oak Tree is widely recognized for its disciplined approach to value investing and distressed debt strategy. Beyond his investing success, Mark is also a widely respected thought leader. His Investor's Memo, published since 1990, are considered essential reading in the financial world. He has authored 2 best-selling books, The Most Important Thing, A Guide to Mastering Risk and Decision-Making, and Mastering the Market Cycle, a deep dive into market psychology and timing investment decision. With decades of experience, Mark remains one of the most influential voices in investing, helping professionals and retail investors navigate financial markets with confidence. Howard Marks is a legend. He's an investor known for his expertise in risk management, market cycles, and contrarian investing. Let's unpack some of his core ideas, because whether you're new to investing or a seasoned professional, Howard Marks' approach can truly change the way you see the markets. In Howard Marks' view, the most important job of a professional investor isn't just to make money. Most of the time, markets rise on their own. Marks believes that the real challenge is to earn returns while controlling risk. Risk, he says, is certain, but what sets top investors apart is how they manage it. If you take one thing from Marks, it's this: your job is to ensure survival. Great returns are meaningless if a single market downturn wipes all your hard work. Howard Marks reminds us that the future is uncertain. He quotes economist John Kenneth, who said, "We have 2 kinds of forecasters, those who don't know and those who don't know they don't know." Geopolitical surprises or sudden economic shifts that are unpredictable often fool even the smartest analysts. Mark says we do better focusing on what's within our grasp, evaluating individual companies, understanding industries, and recognizing current market sentiment, rather than pretending we can predict the future. So instead of chasing predictions, Marx teaches us to focus on what we can control, because in investing, certainty is a myth, but preparation is power. Howard Marks believes that the market doesn't just go up and down. It swings between excesses and corrections, much like a pendulum, constantly moving from one extreme to the other. When optimism and risk-taking pushes markets too high, the pendulum swings toward excess. Eventually, reality sets in, fear takes over, and the pendulum swings back towards corrections. On one side, we have excesses marked by booming optimism, aggressive risk-taking, and soaring prices. On the other hand, we have corrections defined by fear, pessimism, declining prices, and restricted capital. Understanding this nature rhythm of the economic cycles is key to making smart investment decisions. Contrarian investing is the strategy for going against prevailing market sentiment, buying when others are fearful and selling when others are overly optimistic. Instead of following the herd, contrarian investors seek opportunities where market emotions have created mispriced assets. Howard Marks offers a simple but powerful tip. Strive to be counter-cyclical. When the market is excited and risk-taking is wild, it's time to be cautious. But when fear dominates, prices are falling and the investors are panicking. That's often the best time to step in. True investment success comes from seeing value where others see uncertainty. Mark says one of the biggest dangers in investing is our own emotional swings, from fear to greed. When markets soar, we feel we can't miss out, leading to overpaying and ignoring risks. When markets tumble, we panic and we sell at the worst possible time. This is exactly why contrarian investing is so powerful. Instead of following the crowd, successful investors go against the market sentiment by controlling emotions and thinking independently. Investors can take advantage of underpriced opportunities. If you can keep your emotions in check, you're already ahead of most investors. We're in what Marx call low-return, high-risk world. Interest rates are low, valuations in money markets are high, and it's easy to get burned chasing returns. So how do we navigate? 1. We stay invested but be cautious. Howard Marks doesn't advocate withdrawal from the market. Instead, he suggests maintaining positions that favor defensive assets and more cautious strategies. And 2. Be selective. Look for specific industries, markets, or emerging opportunities rather than blindly buying broad indexes. 3. Be ready for corrections. Have a plan to buy when prices drop. Embrace volatility instead of fearing it. And 4, don't stretch for yield. Reaching for high returns in riskier areas can backfire. Always ask if potential reward justify the risk. In a world with so much uncertainty, focusing on quality and fundamental values is the safer way to seek growth. Howard Marks teaches us that we don't need a crystal ball to be successful investors. What we need is discipline, emotional control, and a clear understanding of where we are in the market cycle. He simplifies his core ideas into 3 key principles. 1. Manage risk first. 2. Accept that you won't be able to predict the future perfectly. And 3. Use market cycles and investor psychology to guide your decisions. Follow these simple, profound lessons and you'll avoid the biggest pitfalls and mistakes that trap so many investors. For those who want to hear Howard Marks' wisdom in a fantastic lecture delivered in May 2019, check out the link in the video description. Be sure to check it out. I have a 2-part question for you. How would you characterize the current global investment climate? Are we truly in a low-return, high-risk world? And second question, do you think we're in a period of excess, correction, or somewhere in between? Share your thoughts in the comments below. Before we wrap up, I want to introduce GG Easy One, a blockchain project I'm co-founding. The mission is to tokenize sustainability assets, creating a stable and transparent sustainability-backed cryptocurrency. We aim to make investing in sustainability as easy as trading crypto. If you're interested in learning more about Web3, blockchain technology, cryptocurrency, economics, and investing, plus to follow the GG Easy One startup journey, then please follow us on social media. Next week, I'll be releasing a new video about Bitcoin and to answer one of the biggest questions in crypto. Where does Bitcoin actually get its value from? Trust me, you don't want to miss this one.